Jim, I want to start with you because I know you've been watching a lot of headlines in geopolitics, not just tariffs. It's got you a little concerned despite the markets generally shaking it off right now.
Yeah, I've said for some time, Courtney, by the way, welcome. Good to be here with you. I've said for some time that trade policy uncertainty is the biggest thing facing the market. Well, this weekend, geopolitics said, I'd like a word. And there's some things that happened this weekend that are pretty dramatic. The Ukraine strike on the Russian air bases is one hell of a blow. And I think we got to be careful here. Now, I'm not pushing the panic button. I don't want anybody watching to feel that the panic button is being pushed. What I am saying is this would be a good time for geopolitical hostilities to ratchet down, not further upward. It's not just the Russian-Ukrainian strike. It's the comments that Peter Hegseth was making on Friday. That's the Secretary of Defense regarding China imminently being prepared to do something about Taiwan. And then there's the ongoing intractable situation between Hamas and Israel, and Israel getting more and more concerned that the U.S. is going to make a deal with Iran that is going to allow Iran to eventually get a bomb, which to Israel is unacceptable. So there's a lot of geopolitical hostilities here that we would like to see ratcheted down. There is maybe, Courtney, going to be a talk between Presidents Xi and Trump. That would be a step in the right direction. I'd like to look for that. In the meantime, it is still trade policy uncertainty. I don't want to lose sight of that. We've got 1 month, more or less, until the pause on reciprocal tariffs goes away. We need to see some trade deals come through before those reciprocal tariffs come back in force.
Yeah. Go ahead, Joe.
The market's trading pretty well, though, despite that trade news. We've got a lot of resiliency. 3 weeks ago, coming off of the Geneva trade and economic meeting between the Chinese and the U.S., market gapped up higher from 56.91 to somewhere around 57.67. Since then, we've been in a range, 58.30 to 59.68. That's what we're doing. We continue to see stocks making 52-week highs. You look at the S&P 500, I think there's 15 of them today making a new 52-week high. 52-week lows, only 4 today. So you have momentum right now is a very strong factor. And what's interesting about it is it's not in the normal places. We're not sitting here talking about, oh, Apple's making a new 52-week high or Alphabet's making a new 52-week high. It's names that we really haven't spoken much about over the last several years. It's names like Zscaler and Spotify and Palantir and Netflix and Rollins and CME and Chewy and Hood and Howmet. These are the stocks that are moving the markets higher. You have equal weighting working once again. And logically, you say to yourself, OK, we've had a remarkable run from the April lows. So it makes sense that the market now would maybe moderate those gains and correct at some point. I wouldn't be surprised to see that. But you have to have the market dictate to you that that's actually what's going to unfold, and I just don't see that in the near term.
Yeah, there's so many cross currents going on right now, Weiss, and it does seem like we were reactive to tariff headlines in March, April, maybe less so in May, because the S&P 500 and NASDAQ both coming off their best months since November of 2023. The leadership is changing. What's your playbook right now to manage through the cross currents?
Yeah, so yeah, we had a great month, and we just barely in the S&P, not so in the others, covered the losses that we had. So it's kind of, so you can't look at one data point and say the market's been great. It actually hasn't. It's bounced back significantly since the lows. In terms of, I agree with everything Jim said. I mean, you've got heightened issues across the globe. I don't know if you mentioned Poland or not, but that's another one to throw in there.
Sure.
Because we don't know what happens now with Poland and Ukraine, Poland and Russia, right? Poland, in my mind, they'd be insane to not support the war in Ukraine. And in fact, the person who won the presidential election has historically been supportive of it, but now there's a question because they're next, right? They're on the board of Ukraine. Look, you know, we're sort of immune to the tariff noise at this point because of taco, right? Because it always comes back and everybody's not getting worked. Nobody's really getting worked up about the 50%. It's positive for Cleveland Cliffs if it happens, but who knows? Tomorrow it could be 10%, or it could be us paying them to export here. So you just don't know. But what you do know is that the market has done well. It has momentum. The places to be that I think are defensive continue to be, and where most of my portfolio is in big cap tech. It's not in Apple, though, because of their unique China issues. But I still think that that's the most defensive place to be. Healthcare typically defensive. It had the worst month last month, right? So all bets are off there. Every part of healthcare is up for grabs. A lot of that, though, is
because of UNH and Eli Lilly. That's 20% of the healthcare.
It's also up about Medicaid. It's also down about
I'm saying
Medicaid.
When you look at the performance of healthcare.
Yes, no, agreed.
Yeah.
But I'm just saying that it's not a safe place to be. So
it's an interesting position that you're taking because Roth Capital thinks tech's losing momentum. The new money is focusing on defensive. JP Morgan thinks there's going to be a leadership change. They're not all in on the Magnificent Seven.
Right. And I'm not all in on them. As I said, not Apple.
Not Apple.
Okay. Google, I think it's actually okay here, but to me it's Meta. To me it's Netflix, which is not part of Max 7, so that's where there's a leadership change.
Okay.
But to me, they've got defensible moats. They could be taxed 10%, as talk is around the world. We just tax these tech companies 10%. Bottom line is that's where you want to be. As far as the rest of the market, it's just way, way too tough. And anybody who can be sanguine about this market going forward, when you've got valuation levels that are where they were a year ago, where you didn't have a lot of this nonsense, you can't tell me why reasonably that the market should be valued. And keep in mind the chorus of people saying that we were overvalued then, due for a correction. Now that's on steroids. So just throw a number out there. If you're putting all the things that Jim talked about, some things I've talked about, some things Joe mentioned into the market, to me maybe the multiple is 26 times. You're seeing a record cut in earnings estimates, and I'm just throwing it out there to make a statement, not to say it's the actual multiple. So look, I'm not adding here unless you get phenomenal opportunities in certain names. I just think that you want to wait and see.
Jim, jump in before we grab Brent.
There's one saving grace here, which has to be acknowledged, which is the strength of the labor market. Because I understand, Steve, and unfortunately agree with a great deal of what you have, kind of, for lack of a better word, your negativity.
Right.
Right. I mean,
cautiousness,
whatever word we want to use. But what has not happened so far, and this is really important, is that companies have not been laying people off. Let me be a little more specific on that. Small businesses are having a hard time. If you read the Fed Beige Book, small businesses, particularly in manufacturing, are laboring to maintain profitability in light of higher costs of raw goods because of the tariffs. But large companies are not laying people off. We're going to have an important tell on this on Friday, but so far the initial weekly jobless claims are hanging in there. This is important because it's allowing GDP to continue to expand. Now, the Atlanta Fed GDP has a lot of net export, net import noise in it, but still, consumption is growing. That's the biggest part of the economy. And until we see initial weekly jobless claims start to spike, then it looks like we can get through all of what Steve and I are talking about.
That's not part of my thesis, by the way. And it is cautious, and there is a big difference between negative and cautious. And that's because the cost to recruit, to rehire, they went through that in the pandemic.
Agreed.
They don't want to go through it again. So that's going to be the last to go. Cap spending, CapEx, which is a big part of GDP also, is the first to go. And we're seeing that already. If you talk to CEOs, they're frozen.
I mean, Brent, it's very interesting. Eddie Ordeni sort of makes this point in saying the economy remarkably resilient, really, despite sort of everything that's happening with Trump's policy or potential policy that we're hearing from. I am, though, to the point that's being made on the desk, starting to worry about jobs. Obviously, you all know that I cover retail as a reporter for the network, and so I'm really thinking about how they're going to manage the costs. And look, if a cost goes up here, one way to lower costs somewhere else is to cut some of your labor pool. What are your thoughts generally on where we're starting the month of May when we're trying to balance month of June rather, as we're trying to balance all of this?
Well, May was the best year for the S&P in 35 years. And obviously April was probably one of the worst. So they do balance each other out, as Steve said. I think as it relates to retail, where you have to be careful is you see Abercrombie had great numbers, yet Macy's is closing 150 stores. So I think retail has its own retail issues and is not a broad depiction of the jobs market writ large. I think the jobs market's going to remain strong. It's going to remain strong, and we're a consumption economy. We're a service economy, and so we have so much resilience. And really, there hasn't been much change. We keep talking about all these tariffs, et cetera, but really, we haven't seen a lot of implementation. I think as it relates to, like, how do you play this market? We're in this, let's say, 5750 on the low, 6,000 on the high. We couldn't, punch through that. And so now we're in this middle ground. And I think what's interesting, though, is you have, certain stocks and sectors are below their 200-day moving average, like an Apple, a Google, Joe's point on healthcare. You've got energy. And so I think you need to be mindful of those sectors and security. Salesforce is below the 200-day of being mindful of that ceiling versus if we get a little pullback, you have technology, you have the financials, you've got so many stocks above that 200-day. And so from a buy the dip mentality, I think you want to stick with those stocks that have punched through that 200-day and buy the dip if you see them come down and still like fade those names that are underneath the 200-day, because I think that's going to continue for the summer at least.